The Hedgeless Horseman here. It's August the 17th, 2023. Yesterday was, I guess the last 2 or 3 days have been pretty rocky. The markets have been taking on some water, and you can kind of sense the panic. Bad news out of China. 10-year yields in the US going up, and basically everybody's starting to lose their minds, increasingly so. And of course, to me all of that is noise. I have one reason to buy and one reason to sell. If it's cheap, I buy. If it's expensive, I sell and buy something else. That hasn't changed, obviously. If anything, some stuff has actually become even cheaper. But that is not the main focus of most people, vast majority. Everybody, like always, plays the game of guessing where the price is going tomorrow. And you hear a lot of, let's say if I post this chart, for example, it can get worse, and people just saying, well, I think we're gonna go down more, and all of that. Implying obviously that they're always talking about the short term. We can go down more from here. So this is again what people focus on. This is of course the same reason why people absolutely pile on up here when where it actually can and will get a lot worse, because they're hoping for this. But that's not the big picture. Okay, so here we have, let's say, risk to the upside, a double. And this was in the hottest market in ages, I guess. Same here. That's your upside. Greater fool upside, because they were sure expensive up here. But the downside is obviously much worse than the potential benefits. So the big moves around these levels is going to be down. That's a matter of when, not if. And the big moves from these levels is going to be up. And that's a when, not if. So that's what I'm positioning for. Again, you don't need any real market timing at all when you get to extremes, even though it typically even if you get in very low, which would be here, that's still 36% downside from here, almost 50. So of course that doesn't sound like or look like a small retracement, but the big move is still the other way. Again, that's how it is, and nobody knows when that will happen, but that's what everybody does. Everybody's trying to predict where it goes. That's why, typically, I would say technical trading accounts, they have a lot more followers than people who do the unsexy thing and just talk about, let's buy something cheap and hold it until it's not cheap. Basically not trying to comfort that much by, describing what's going to happen in the near term. And that's of course why crypto accounts, at least when everything was going up, etc., they had hundreds of thousands of followers to millions. I think Michael Saylor is up to, 2 million followers perhaps. Maybe even more today. It's the easy money people want. People want to make money all the time. That's the idea. That's that's the holy grail. That your portfolio would only go like this. You would be, because everything corrects. Absolutely everything corrects. Even the best success stories corrects. But over time, the ones that are successes, they go up. But nobody even wants to have something like this. Everybody wants to be rightly positioned for every week, every day. So that's why they put a lot of effort, or I mean, the main focus is, again, where is the short-term trend? What is the short? Where is price going to go tomorrow? And obviously, it's kind of easy to see what the trend has been at the extremes, because it's never been more clear of a downtrend, and here it's obviously never been more clear of an uptrend. Same here at the absolute bottom. Anybody who looks at this for sure knows that it's in a downtrend. So they will always guess that it's always going to get lower, especially the lower it goes, the longer the trend has persisted. Meanwhile, you should see that as more and more relevant, because you know that when you get to extremes, the next big move is going to be the opposite way. But that's not what people do. That's why people don't buy these extremes, because they don't want to suffer the prospect. If there's downside risk, which there always is, they get scared. If the trend has lasted long, they are firmly convinced that, you know, it's going to continue down. That's just how it is. So I think the last year has been, you know, already in deep no-brainer territory. And I obviously pick the companies I like, which I think have either are very, very cheap right now, or have a fundamental uptrend in place. So it's just going to look cheaper with time if the price stays the same, meaning there's going to be mounting pressure to want to close the price to value gap. And that's typically, I mean, like the HODL portfolios, where the case is intact, fundamental trend is up, the companies could grow their value, you know, 2-3x over the next 2-3 years. So that's gonna, I mean, kind of, you know, bail me out regardless. If you get that right, or that plays out, and you buy cheap, I mean, it's gonna go up eventually. So that's why I have massive paper losses now and then. I mean, every other year, I would say, but that always comes back, because at the end of the day, the market is going to be a weighing machine and not a voting machine. So it's like, I'm not surprised that I mean, if you think I'm going to be surprised if I make a lot of money from these levels, I mean, then you're wrong. I can't see how, if you buy this cheap and you just get how a cyclical market works, I mean, there's really nothing that can stand in your way, I was going to say. But I do, I mean, I do find it fascinating, because right now, for example, on Twitter, at extremes, it's the peak of people being wrong. Everybody's convinced here that this will continue up. Everybody's convinced here that this will continue down. So, I mean, I would say that the online chatter, I mean, there are some obviously good accounts and good, I was going to say, contrarians or value investors, but it's like, it's I think it's a big disservice reading Twitter the cheaper it gets or the more expensive it gets, because almost everybody will agree on the same thing, which will turn out to be extremely wrong. Like now that, hey, you know, it's gonna get worse, it's probably gonna get worse. It's like, yeah, that's the thing. It's like the headlines one would expect at extreme lows or extreme highs should be very skewed. I mean, it would be surprising if the macro and all of that and sentiment, I mean, if that was a negative, we wouldn't be here. So at the bottoms, I mean, that's when, you know, you have the apocalypse thing going on. And again, it's like people focus on this right now. You know, it's probably going to go lower. It's probably, that comes from people who probably will never really make any money in this sector, and probably never made any money in this sector. But they're still, again, they're driven by their emotions, and that's their fear is telling them that that they should be afraid, etc., etc., and they'll probably never figure out, why they never are able to have any solid long-term results, because now it feels right to worry about the downside because everybody's worrying about the downside and the sentiment is depressed. So if everybody's talking about the same thing, focusing on the same thing, it makes you believe that that's the thing to focus on. If everybody's talking about it can get worse and, look at this bad headline, or it's like, I think it's going lower, because obviously everybody thinks it's, here everybody's convinced that it's going lower. Because then all of a sudden almost everybody that is willing to sell very, very cheap has sold out. So everybody of those people were convinced at this point that we were going to go way lower. And all of a sudden, every one of those people are out. They've sold all their shares. Somebody's been planning to, somebody's planning for the next big move. They are the ones buying them, and then the big moves comes because the weak hands are all out. I don't see how I can justify. I mean, to me it's pretty easy because I am a value investor, I don't see myself as a contrarian. It just ends up looking like you're a contrarian, but in reality you're just sticking to your value investing guns and knowing what the next big move is. I cannot see how I can look at, let's say the higher quality names and you might be convinced like, hey, these are probably worth 200%, 300%, 400% more than what I can buy them for. How can I justify selling that? Because I think they might get cheaper for a while. Then you're playing not to lose. I'm playing to win big, huge. That's why I started buying in August, I think, of 2015. I would say maybe the sentiment is even more depressed right now. I don't know. But the thing is, I try not to hold any crap. If I held crap right now, I would be scared to death. Because something going wrong is a matter of when, not if. If you have a solid company, fundamentals are intact, good management team, whatever, they are going to trade way higher than here. And just to show what I mean about, everybody's focusing on the wrong things, like this is 1 year time span. This was the COVID flash crash. My portfolio, without any whatsoever changes to the actual companies, without even gold going down that much, people sold the stocks that I owned so that the average junior was down 56%. I think that was just over two months or something. 56%. That would, a lot of people would see that as an absolute disaster. I know, especially, I've heard that some, trading services recommended their readers to sell. I think paid technical analysts recommended them to sell the bottom or close to the bottom because the technical short looks so bad because it broke down below resistance. I didn't sell a single share because I know those prices were not real. Those were gonna get fixed because the value didn't go down by 56%. Price went down. People were willing to part ways, sell their ownership of the company, of the juniors, for 56% less than 2-3 months earlier. So, okay, if somebody looked at my portfolio at that time, and let's say I was bullish, people would say, How can you be bullish? You're down 56%. That's an absolute catastrophe. What are you doing? You know, this is why you have to market time. Well, it ended up pretty well, even though it was a rocky start of this 1 year time frame. My goal is 50% per year. This was actually a very, very good time span, and that included one of the worst paper losses I've ever had in my portfolio. It was absolutely the worst in the shortest time frame, at least. So it was a very intense flush out. But since I'm a value investor, you know, value/growth investor, even though they're the same thing, I can't complain. And of course, the thing is, when people sold here, maybe because of technical analysis, maybe because they were scared, nobody in the right mind could look at the prices of these companies and say, yeah, that makes sense that, you know, because value has fallen 56%. That was absolutely not the case. And of course, if you're worried about this, you might be selling out more and more the lower it goes. And then you're gonna, you know, I'm gonna get in at the bottom. I'm gonna get in at the bottom. Good luck, never gonna happen. Absolutely, you're not gonna get a full position at the bottom tick. You won't know where it is. And that might last for a split second. But to show why I think, again, why you should focus on the next big move, well, this kind of makes it abundantly clear, I would say. But to show just how bad it is to be selling extremes, how selling is the worst, holding is bad, buying is the only thing that makes sense. So over this time frame, 282%, if we look from somewhere around the bottom to up around here, 791% my portfolio did from the bottom. I assume I did. I don't even remember actually what happened. But I assume I did some value shuffling. Because like I've been talking about many times, well, we can go to this one actually. Yeah, value shuffling. Volatility is the poor man's currency. So if I am out of money, I'm fully invested, which I typically am all the time. The only way to further increase my future net worth is to do value shuffling. And I've talked about this many times. If I own 20 stocks, I think they're equally cheap. I think they all have, let's say, from this level here, maybe I think, hey, on average, not that everyone will, but on average, I think my 20 juniors will get me a 300% return. All those 20, exactly the same priced. Volatility happens. You know, like now, we're seeing, you know, headlines, fear-mongering, you know, it can get worse, blah, blah. If there's just one guy that gets scared, let's say, and sells an intact story out of, you know, one of my 20 juniors, which I have 5% position in each, if that sells off by 20% or 30%, maybe that particular stock, just because someone got scared, one person in the whole world, or that owned the stock, or a fund need to liquidate, whatever, somebody is forced or gets scared enough that they sell. Just put in a market sell order because they think, hey, you know, I better sell now because I think it's going to go lower. Okay, let's say they sell here because they think this is going to happen, and maybe they will be right, but they won't buy this, obviously, because then they think it's going to get even worse. And I buy those shares. Maybe, I mean, they're giving away potentially huge future returns. And maybe the other stocks that I own was gonna, well, let's say 400%, and all of a sudden that stock sold off. I buy that and get 100% extra return. I'm doubling my money once again. Instead of a 4-bagger, I'm getting a 5-bagger on that money. So I'll pick that up. Let's say that 1 out of 20 stocks gets irrationally cheaper than the rest of them, and everyone is irrationally cheap. But thanks to that negative volatility, price going down for whatever reason, let's say I shuffle some of the money from the other ones into that one, all of a sudden my portfolio actually is down on that day because that stock went down. But it's going to go up later, but it went down on that day. So my portfolio took a hit. But I was proactive, realized that, hey, this is all of a sudden better, an even better buy than the other 19. So maybe I don't have a, first of all, it goes down to, let's say, maybe from 5% position to, let's say, 3%. So we're talking a 40% decline. So that position goes down to 3% of the portfolio. But all of a sudden that also means that the opportunity went up a lot. Because I'm going to get an extra, let's say, 100% future returns. So I go from a 5% position to a 3% position in that one. The other ones are still at, 5, even though, they would be a bit more than 5 because the one of them went down, but still. So I go from 5%, let's say here, it goes down to only being a 3%. I realized that the future expected returns are even higher all of a sudden. So that 3% position, I jacked that up to 8% perhaps. So now all of a sudden, the one I think will be the biggest earner in the future also has the most, I have the most exposure in. So the other ones might be, 4.9%. All of a sudden I have 8% in the one that I think will not do 400 but 500% going into the future. So again, at the point of where I do the reshuffling, that day my portfolio is down. So at face value, this looks like a bad day. In reality, because I was proactive, realized that this is just going to make me even more money in the future. When I look back in hindsight, my portfolio might have ended up here. But thanks to that stock going down that day, me being proactive, putting more money in a store that I think will give even higher returns, when we get to the next sentiment high, maybe my portfolio will be up here instead. So I'm creating a better future by taking advantage of the bad present, quote, bad present. That's why, that's the only way I can really explain it, why it's like when these things, when we actually turn around, I would have done value shuffling, just waiting to pounce, waiting to see what kind of mistake, because I think everybody that's selling in this area for the last year, on a long-term basis, I think they're making huge mistakes. Not that every store will play out and be a 10-bag or whatever, but on average, everybody I think is making a mistake being a net seller over the last year. So that's what I do. I let the opportunities come to me. You have something that sells off, people will see that as a negative. Maybe they will sell out because, again, they fear that it's going to go down tomorrow. But I'm continuously upgrading the future returns in my portfolio by using volatility. The only other way how I would get a higher net worth in the future would be if I deposited more money. So if I don't have money to deposit, I have to be proactive with volatility. That's how I create future money without actually depositing anything. That's why I am I'm not gonna say I'm rooting for a market crash, or things to get even worse. But if it does, as long as not every single stock I own, every single opportunity gets better at the same time, I can create future money. Because let's say I own 20 stocks, everybody's equally cheap. Let's say here's where they are trading. All 20 stocks, here is where I think they are worth. And let's say all of them go down the exact same amount and the opportunities stay the same. There is no way for me to increase the future returns in that case. Then I have to deposit money, because no opportunity got better than another opportunity. So I couldn't just value shuffle and get a higher future return. But if let's say a few stocks went down here and one stock went down here, then I can use the let's say sell a bit of the other 17, which I still think are buys. And that's the problem with when people say what are you selling or what are you buying? That depends on how much money I will do. I have a full position, what's happening, because something can be a huge buy right now and I can still be selling it if there's an even better buy, which I don't have a position in, etc. So it's kind of meaningless, because it's, in my opinion, now it's just a matter of degrees of buys. But again, so I take some from the 17 that stayed put maybe. Most of it will go into the one that irrationally went down the most. And I'll probably jack up ownership of some of the 2 or 3 stocks or whatever I said that got cheaper as well. But most will go into the cheapest one, which again, at the time of the reshuffling, was the smallest position. So maybe that went down to, again, like from 5% to 3% of my portfolio, but I jacked it up to maybe 8%. And because the case is intact. So that's going to be the main earner, the one that performed the worst on that day, and was the biggest reason for why my portfolio was red that day. But thanks to that stock, that intact story going down in price on whatever day, and I realized that was just an opportunity that was already good that got even better. Put more money in that. That's going to make my future returns go from here to maybe here. So I make future money again by taking advantage of irrationality in the present. Volatility, price volatility. We assume that no change happened, no news was out. At least company-specific news. I mean, yes, there might be. It's like, oh, you have a junior in a country where there's a coup going on. Maybe that could be a problem. So maybe yes, it's still cheap, but the actual value went down as well. So when it got cheaper, I mean, there wasn't really maybe a widening of the price to value gap, because value went down, price went down as well. So it's still cheap, but it's as cheap as the other ones with no bad geopolitical news, but prices are higher, so they're a bit less risky, whatever. So again, it's like, bring on the volatility. That's why I almost am looking forward to. I mean, most people don't get it, so they will run around with the hair on fire. But I am out there, in some illiquid juniors. I'm having stink bids in, and hoping that somebody just puts in a market sell order, just hoping for it. And that I might need just one person to panic sell, and that might get my bids filled. And that those stories which I think might do 400-500%, if they get a flush from here, they might do 700%. So if you know what you're doing, you actually kind of almost want total dislocation. You want big volatility. Market crashes or spike in negative sentiment brings volatility, and it would be interesting just to see that happen. And again, that's why it's like you should not be emotionally affected by it, because everybody else is. So if you're a stone cold killer when everybody is acting on emotions, I mean, I don't see how you can lose in a sector that is this volatile, because the rallies are not your typical S&P rallies. I mean, they are just disgustingly violent sometimes. I mean, look at this. I mean, Jesus, nothing really. I mean, take Bear Creek. I don't think anything changed in terms of value. Price sure went up. Same here. Value didn't really change. Price went down here and then up there. I mean, just see how much opportunity it is in this sector. Holy crap. Within a short time span. So again, I'm preparing already for what comes after this crash, and everybody's preparing for what they think comes in the short term. And there's probably a bunch of juniors that well, first of all, nobody knows when the bottom is in after hindsight. I mean, after a move like this in Bear Creek Mining, and juniors had a pretty big move, I thought this move up here proved that this was the bottom. But if I would have used that as a strategy, I would be buying up here because I think the low is in, and I would be hoping to get, let's say, the last 225%, instead of not trying to guess at all when the bottom is in, and just buying, averaging down. Because then it doesn't matter if this wasn't the bottom. Sure, okay, if it would have gone from here straight up here, yeah, let's say you get a 800% return. Now it went down instead. But that doesn't take away much from your, and again, I'm not buying Bear Creek Mining, I'm using this as a proxy. So let's say you bought here. You added some money here. Okay, it went up, so on paper you were in the green. Then, quote, catastrophe happened, you're even lower. That's still, if the story is intact, you're still going to get the 557%. It's just that, yeah, it's taking, well, another year. But that's fine. 564%, for example, you should be willing to wait 6-7 years for that. And this was just 1 year. But nobody thinks like that. Because the funny thing is that everybody's trying to get 100% every 6 months, while nobody really that does that have even beaten the market over the past 10 years or ever. So that's the interesting thing. Everybody tries to be the perfect trader without even having any sort of solid fundamentals in place. Any more points? Yeah, and just again, it's like good luck know when the bottom is in and getting a full position. Again, it's like there were traders, market timers that sold here because they thought, they were trying to guess where the bottom is. They guessed that the bottom wouldn't be here. And meanwhile, I, who didn't even try to guess, over the same time period, I got 282%. And any money I put in, near the lows could get up to 791% returns, which is absolutely ridiculous. But of course, that comes with a bit of, stock picking and etc. And who knows, maybe at some times it's like, maybe at these levels, I mean, again, I think there's a lot of stocks that are buys, a lot of stocks. I'm almost tempted to buy anything right now. But still, if something goes down 30 to 50% more irrationally, an irrational decline, that might be a 500% bigger buy or 1,000% better buy than another stock that is still a buy. So that's why due diligence, if there's at any point in time where due diligence and doing the work, not following the noise, doing the actual work, thinking about the companies, 80% of the time minimum, I think, should be done researching specific cases. You have no idea how extreme some of these, how extremely better buy some are than others. And that can change with one price decline over 1 week or 1 day. A 20% dip in one stock might make it a 500% better buy. It's just absolutely crazy how much price changes risk reward when you're already at extremes. I mean, it's like some people, there's some, let's say, juniors out there with, they're trading close to cash. But people are kind of willing to sell those because they think price could go down. Let's say you have a company with just a theoretical scenario. Let's say a OK junior, micro capper, trading at 5 million, intact story. Maybe they have some ounces. Let's say they have 4 million in cash. That gets cut in half, so it goes down to 2.5 million market cap. It has 4 million in cash. And let's say even the company might be, smart, and they're like, okay, let's not burn that much money right now because we're not going to get anything for it, really, right now at least. But the story is intact. If they would have 2 million in cash, let's say 2-3 million in cash, market cap 2.5, intact story. When sentiment turns around, let's say within 1-2 years, and then they can put some money at work, whatever, you have no idea how high that could go. From 3 million to take it to 30 million would be a 10-bagger, and if they actually have something, that's going to go higher than 30 million. So this is where if you want to try to get 10-baggers or even more than that, the odds of finding one is extremely higher here than here. Up here, it's got to be super hard to find something that's going to 10-bag over the next 2, 3, 4 years. Up here, extremely hard to find something that would 10-bag over the next 3 years. From here, heck, even crap can fly, and Bear Creek can do 5 to 8 bags without doing anything. So again, if you're down 50% at around these levels, or it goes lower and you're down 60%, whatever, I don't see that as a problem at all unless you own crap. If you're down 50-60%, you would only need 100% higher in order to be even. And like you can see here, when my juniors turned around, they didn't do 100%. They did hit several hundreds of percent. So just from this period here, this would have need to go down, 70% more than that, just to have me break even over this time period. It's just crazy. And obviously, again, if you do some value shuffling. Anyway, so let's look at some stocks. District Metals, I put out a piece on District Metals recently. I think, again, this is like, I think District Metal is incredibly cheap, but this one has some, let's say, it has some if questions, because if the moratorium gets lifted in Sweden, uranium moratorium, all of a sudden I think District Metals will be extremely cheap. If that doesn't happen, I think at these prices, District Metals will still be cheap, because in my opinion their base metal projects in Bergslagen is worth more, especially together, than the current market cap. Tomtebo alone had District Metals valued at 30 million in 2021. When they only had this, it was valued for a while at over 30 million. Now it's down to I think around 16-15 million with like 2.5 million in cash. So it's valued at half of what it was just 2 years ago, when they only had Tom Tebow. Now they have Gruvberget, Svärdsjö, Viken, Tåsjö, Arnasvare, Sågtjärn, and they also have Bakar. They might have had Bakar, but it's like nobody can tell me with a straight face that this sector is so hard. Price has gone down from the peak, I think 70% in district metals. Sure, they've done some dilution as well, but not that bad. Price is down 70%. Their asset base is up 7-fold. You can just imagine what the price to value gap is. And sure, I mean, Viken and second largest uranium deposit on Earth, these are at face value kind of worthless right now because there is a moratorium in place. But that's the bet. That's the risk reward. If Sweden lifts the uranium moratorium, which I think gets increasingly likely given the headlines out of Sweden that they're aiming for 10 new reactors or something, and the Niger news about a coup, and Niger supplies like 25% of Europe's uranium. I think there's mounting pressure on Sweden, which has like 25% of the uranium endowment in Europe, to lift the moratorium. That's a pretty good bet. That's like at face value, that's, if there's a 50-50 chance, that's like 50% chance that it does not go through. And I'm still buying all the base metals and Bakar for cheap, because I think they're worth more than the current price. If the 50% chance happens that they lift the moratorium, all of a sudden the cumulative value might be, well, I think it's going to be even higher than here, but still it's like multiples of where it's trading at. So it's like worst case scenario in a sense, even though it's like worst case scenario would be a meteor hitting Sweden, but still worst case scenario, you bought it cheap. Best case scenario, you bought it extremely cheap. Imagine having hands like that in poker, where it's like, hey, I'm playing this hand. If the, let's say, bad case happens, I don't lose money. If the good case happens, I make a lot of money. How many hands do you think I would play that had those characteristics? I mean, even if you have aces, which obviously is the best hand, there's an 82% chance of winning. If you're playing against one person, there's an 82% chance of you winning 100% and an 18% chance of you losing your stack. Well, the money you put in. So that's that's not really asymmetrical. It's just that the win chance is high. If you win, you double. If you lose it all. In the investing, you can get bets that are absolutely that any poker player would kill for, would play every single day forever. So that's the thing. I look at every single stock as a hand. And people are willing to sell hands like this because they fear the price might go down and the hand might get even better. Why on earth would I sell a extremely asymmetrical risk-reward hand because I think it might get better? It's like you're sitting with, it's hard to translate to poker terms, but it's like, no, I'm sitting with like a pair of aces that if I win 5 times the amount I would lose, which everybody would play every single day for all eternity, because it can't go down in price, and the win chance goes from, or whatever, I can make 7 times my money instead if the hand wins. You would still play the 5 times X if you win every single time, because you're gonna make money on that. It's just that if it goes down in price, yes, you'll make more money, but you're not gonna have a losing portfolio, if you know what I mean, if you can just play 5x aces all the time. So it doesn't make any sense. That's why it's like would make no sense, in my opinion, to sell an extremely good hand because it can get a bit better. The problem people have is not that they or I should put it like this: you don't have a problem if you have hands that pay off, have a, let's say, a high win chance, and if you win you get 5 times the money. If you lose, you don't really lose much. If you could play hands like that, you would do extremely well in the market or in poker, for example. But still, people don't make any money in this sector, and I don't get it. It can't become more obvious. If you're one of those, which is like 95%, who, regardless of how extremely good the hands are, you're willing to sell it because you think they might get better by price going down. It's like, is there a surprise that you don't make any money? I mean, up here, for example, you would actually. These are bad hands. Up here, you might have, if your hand wins, you might get a double. If you lose, you're down 90%. That's a friggin' bad hand. Down here, it's like, well, worst case, they get cheaper for a while. Again, we're not talking about the crappiest of companies that are near bankruptcy. Worst case, they get cheaper for a while. But you kind of know that eventually they'll pay off hundreds of %. That's extremely good hands. Why would you sell that just because you think that might get better? I mean, does it make sense? Somebody sold down here. Why? Why did somebody sell down here? I don't get it. I don't understand what is so hard about this sector, except that yes, you need to suffer heavy paper losses now and then. But the whole reason I love this sector is because it has heavy paper losses and then goes up exponentially. If this sector wouldn't go like this, it would be really hard to make any real money. If it would go like this, where's the opportunity? Where's the mispricing? No, to just tick, 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 tick. Sectors like this, I would not have a chance of having my portfolio perform the way it has since 2015 if it didn't go like this. If it was just an ever expanding uptrend, well, let's say I got in here, that's what, 385, 80%. That's what people would consider good. That's not good to me. That's if we just assume it's like, yeah, again, ever expanding after, and people like, oh my god, I mean, I'm making so much money, 10-bagger in 14 years. I mean, I guess that's actually good. I think so, at least. I mean, it beats the average market. But hey, in 2029, I expect to be up, I don't know, 100,000% from this level. At least in my smaller, funfolio. So again, if you want to be able to make a lot of money, you want an extremely volatile sector. But that comes with having 3 years of down action. And of course, everybody will sell out at the end, so they're missing the whole point of this sector. They don't stick in long enough to get their money back and more. That's how it is, unfortunately. Well, unfortunately, I mean, that's why the few people who actually have common sense and don't let their emotions get a hold of them, they're preparing for this move already. This is all I'm focusing on. I think I'm gonna do another video instead of going. This took so long. But just remember this. Again, value shuffling, volatility is the poor man's currency. So, for example, I mean, what I mean by that is that if we take this, for example, at face value, this was a disaster. 95% of people would see this flash crash as a disaster. Because if you're 100% long, you're gonna take kind of the full brunt of it. Yes, that's true. But if you're proactive, if you realize that, hey, there are some stocks, well, none perhaps should go down, at least 56%, but some went down 30%, some went down 70%, whatever. If you realize which ones, I mean, they might have started off, all of your holdings might have started off as equal buys. But as soon as price changes differ in between them, that means opportunities are changing. So again, at face value, you were down 56%. 56% less money on paper in the portfolio. But you were proactive. You bought more of the ones that are intact and maybe went down more than others, etc., etc. So even though it didn't show anything, let's say you reshuffled here at the bottom. You were long all the way down, minus 56. You have 44% left over your portfolio. Paper loss intact, if you know what I mean, but you reshuffle. Your portfolio doesn't maybe changed a lot at this point from this point. But again, you took the full paper loss, but all of a sudden you did some good value shuffling. You realized that some had become much better buys than others and you held them. So you sold some of the ones that, yes, are, maybe very good buys, but you sell some of them to buy some that are extremely good buys. So again, nothing changes at face value at the time. You're down as much as you were because you're just selling something, buying something else. You're selling something that went down in price, so you get less for it, but you're buying something that you also had that went down in price, but all of a sudden the expected returns in the future of those that went down more might be higher than the things you sold. So you're creating future performance, even though it does not show up at the moment. Here everybody's, or most people, are sitting at big paper losses and maybe are not proactive. They're just barely holding on, not putting any more money. Imagine if you're not only value shuffling, but you're depositing more money at the extremes. Their portfolios are not going to look anything alike. The ones who had a hold, he might have who just held, let's say he gets 400% on his 10,000. Let's say there's a guy that's value shuffling and buying. So let's say his future portfolio from here is going to go up 500%. Well, that's not an extreme value shuffling, but that's an added 100%, which you would be happy to get if it took 3 years. And he deposited money. So that's what? Let's say, yeah, somebody that just held, he'll be up 400%, so he'll have 50,000. The other guy, he put in 1,000 extra, so he has 11,000, and that goes up 500%. So he will have 66,000 instead of 50,000. That's not bad at all. And think what that means for the long term. With outperformance like that. That's got to add up a lot. That's a 32% outperformance relative to the holder that did no value shuffling. Well, not in pure performance, but in when you I was going to say portfolio outperformance, meaning more money and better returns. That adds up immensely. Imagine the difference of their portfolios over 10 years. If they keep doing that, or I mean for the rest of their lives, that would be probably end up being I don't know, a lot at least. And that's the difference. That's why it's like in the last video I showed that today famous Swedish billionaire, he made a huge bet at crash lows in real estate market in Sweden, and today he's a billionaire. This is at times like this is where fortunes are birthed. They're not birthed here. This is when you reap. Here's when you sow. You can't reap a big harvest if you don't sow a big harvest. That's just how easy it is, and almost nobody on earth can see that. In theory, they have heard about buying low, selling high, but you just look around the Twitter. The funny thing is, like, I mean, think about it. Up here, for example, what is the best risk reward here? Does it make sense to? I mean, what should you be planning for? The fact that the next huge move is going to be down in the sector overall, and stick to picking, even being more firm about what companies you pick, let's say, in order to not be in a pure trading sardine? Or should you keep on trying to guess where the price is going tomorrow? That's the thing. That's what people do. Even though down here it's pretty obvious that the big obvious play is to prepare for the big move that comes next from extremes. If we're here, it's kind of hard to say because it's like almost equally, far away from, I mean, the next move might not be big as up here or down here. So you're kind of in the middle ground. So then it's kind of harder. But when you're up here, why would you keep on like guessing the price tomorrow? Here it's skewed to the downside. Here it's extremely skewed to the upside. But people still do that every single time. They will be guessing what the price is going to be tomorrow here. And that's what dictates their actions and their portfolio. Same up here, even though here short-term trading is probably kind of worthless, and everything should be preparing for the next big flush. Down here, the play is to make sure that you're part for the next big move up. But people can't help being short-term focused, regardless of how much the obvious play has changed. Up here, it's like, I'm gonna be in because I think, the short-term trend is up. Down here, I'm gonna keep trying to trade. I think the short-term trend is down, so I'm gonna be out the market or short or whatever. Meanwhile, I would be preparing for the next big move all the time. Down here for the last year, preparing for the next big move. I mean, that's the obvious play. That is the one that has a high probability of happening and will give a much greater returns, and is for sure easier to do than continuously at every point in time trying to be right in the short term. I'm just going to look at one additional. I saw, this was posted or similar to this. GDX, it's taken a hit lately, filled some gap here. It looks like a death cross has just happened, and it's like, again, spreading a bit panic. Like, just look since 2000, at least 14. How much would you made? I mean, how valuable is a death cross? Okay. Here we get a death cross. So you sell, where would that be? Let's say you sell here. Okay. You sell here, you're out. Okay, now we get a golden cross or whatever it's called. So you buy here. Congratulations, you sold here and bought here. And then the death cross happens. So you bought here because it, a golden cross or whatever it's called. And then you sell when a death cross happens here. Then price is down here. So basically sold lower, bought higher, sold lower. Okay, here, let's see, that's a here. So you bought here. Okay, great. You look at this. Oh my God. Okay, nice. You know, you get a pretty good move here. Okay, I'm not gonna sell until death cross happens, whatever. That would be here when price is down here. So congratulations, you bought here and sold here. What's that, like, I don't know, 10%? So you're out of it now. Okay, great. Golden cross, buy here. Death cross, sell here. Loss. Golden cross, buy here. Death cross, sell here. Loss. Okay, not in it. Okay, golden cross, buy here. Okay, nice. Paper profits. Death cross, down here. I don't know if you even made any money in that case. Probably down here. No, so you might have had a loss on that one as well. And this is, of course, where a lot of technical people were selling. I guess, you know, broke down out of support. You have a death cross, etc. So congratulations. So far you've lost money. Golden cross. You buy up here. Death cross. You sell here. Maybe you made some money. Yeah, maybe 5-10%. Congratulations. Golden cross. You buy up here. Death cross. You sell. Where is that? Here. Loss. Golden cross. Buy up here. Death cross. Sell down here. Big loss. Golden cross. Buy up here. Now death cross. Let's say sell down here. Shitty. You would have made no money over this entire period if you followed the strictly, let's say, the golden cross, death cross. So how worthless is it? Probably super worthless. Obviously. If you just stayed to some good old-fashioned stock picking, bought more the cheaper this was, you would be up hundreds of percent. That's what I keep saying. It's like there's some strategies that are so obviously flawed, and there's some strategies that are so absurdly obvious that it's mind-blowing, and still nobody makes money in this sector. How is that even possible? I don't know. I don't get it. I don't get what is so hard about the junior sector. It's so dumb. The sector is dumb right now. The prices are stupid. They're not real. They're a joke. And one of the day they're gonna be a joke, but to the opposite direction. And then I will be making a lot of money. If that takes 1-2 years, who cares? It's gonna be so worth it that it's not even funny. But in the meantime, everybody's gonna trade. Every extreme, they're still gonna be trading. They're gonna make mistakes. I don't know, use a golden cross strategy in GDX, and Jesus. I just believe in keeping it simple and buying cheap and selling when they're not cheap. I mean, that's in a volatile sector. What other strategy should you have? Okay. Thanks for listening. If I mention any stocks, assume I'm biased, and do your own due diligence. This is, quote, not investing advice, yada yada yada. I don't share your profits or your losses, and of course, like always, owning crap, I was gonna say, that's probably never a good strategy, even though crap can for sure fly in this sector. And I don't think it's ever good to sell cheap in a high quality company, because in time you're gonna make money on it, at least on average, if you hold like 20 different ones. Thanks for listening. Bye.